Now we have the market movements, very dramatic ones in the last few days. Um, could you tell us a bit about, from your research and your data perspective, what are the main factors you think
Sure.
behind this movement?
Right. I mean, it's a complicated story, but let me just isolate one or two. And I think that it does relate both to Japan and the U.S., where last Wednesday the Bank of Japan raised interest rates, and it also announced a tapering program of its JGB purchases. Um, it's called QT in Japan, but the T doesn't stand for tightening. It's just tapering at this point. So we need to be careful about that. A bit of a surprise, a little hawkish relative to most people's expectations. And then, of course, we got the later in the day, in New York hours, the FOMC announcement and Chair Powell's press conference, and then Friday the non-farm payrolls numbers. How do these all come together? Because the combination of Chair Powell and then the allegedly very weak labor data pretty radically changed expectations for U.S. interest rates downward at the same time that Japanese rate expectations were kind of going upward. You kind of got a double whammy for the infamous yen carry trade, let's say. And one of the issues with the yen carry trade is you know where it's financed, but you don't know where it's going. It could be in the most plain vanilla expression, which would be buy dollars, sell yen, or buy other currencies, sell yen. But when you really think about it, carry really just involves a search for yield, and you could fund that yield search in a variety of different instruments. And so once the expected interest rate differential between the two changes, and importantly, once volatility goes up, that's also very important, all sorts of assets can begin to correct. And so that's sort of like the setting of it. I would say that the other issue, and I think that this is picked up by our system pretty well, is that economic growth globally is slowing down. And I think that that's pretty well understood. But our system is saying that growth is slowing a little faster than inflation is slowing. And so that puts some central banks in a bit of a quandary. That's not equivalent to stagflation. I think that that word is thrown around a little bit too casually. But if you really want lower interest rates and you want them soon, you do have to have inflation falling faster than growth is falling. Or else, as Chair Powell mentioned, the Fed would be risking a repeat of what happened between December of last year and the first quarter of this year, where the Fed went dovish in December only to have to reverse that as the first quarter inflation numbers came in pretty darn hot. So the truth of the market correction, let's call it, is that growth is slowing, and inflation is slowing, but not as quickly, and that means that rates might not fall as fast as a lot of people want, and that can be a trouble, especially when we see what's going on in Japan. I hope that was not too involved of an explanation, but I think it is an interesting combination of circumstances that basically happened in a 48-hour time period.
Right. You mentioned the characterization for these market movements. It's my question too. Is it a correction? Is it extreme panic dip that will last for a very short time? Judging from markets' reaction today, a lot of markets are bouncing back very quickly.
Right.
Or is it something, the tip of the iceberg, beginning of something much more sinister? What do you think?
Right. I think it's the tip of a small iceberg, but that it can be avoided. I don't think that we're necessarily going to crash into the iceberg. But by the same token, the recovery is getting a little bit long in the tooth. And that's why we saw inflation rise. That's why we saw interest rates rise. Whatever we want to kind of think about the pandemic, if you draw a straight line from the jumping off point, let's say late 2019, to where we are right now, and just let's conveniently forget the collapse and then the big recovery of the pandemic, the recovery is getting a little bit old. And as recoveries age, spare capital, spare labor gets scarce, and it gets more expensive. and there's a natural element to the business cycle slowdown that central banks can cushion, but there's a real risk if they try to cushion it too much, and I think, again, that was the lesson of last December. You do have to let some of this happen, or else by acting too quickly too early, you'll simply add a little more fuel to an economy that's already kind of operating at pretty high capacity utilization rates. Now, I think that given the rise of the unemployment rate and the deceleration of earnings growth, we're not in a situation that's overheating, and that's why I don't think we're going to get that, not the double dip, but the double rebound, I guess, of inflation. But it does argue for a little bit of caution, on the part of policymakers. And I didn't count the number of times that Chair Powell used the word confidence in the inflation forecast. Our algorithms, or anybody's algorithm, can pick that up pretty clearly, but it was several. And that is the elusive quality, in addition to the quantity that they're seeing of inflation, that is going to determine when and how much they reduce interest rates.
So there's been so much talk and debate about the great unwinding of the yen carry trade. How do you think the recent fluctuation is going to play into that process?
Right. I think, again, there's the fundamental backdrop is, as we discussed at the very beginning, which is that the interest rate, sort of expected interest rates between Japan and the rest of the world beginning to change. I mean, all through this tightening cycle globally, which began in 22, they did begin to exit the unorthodox policies in late 2023. Wait a minute, 2022, sorry. But, it was a long and slow exit, and we only really now have a 25 basis point policy rate. So Japan really was the odd man out, and that's one of the reasons why these carry positions built up. From here, especially if the global trend toward interest rates is going to be a lot lower, I find it hard to believe that Japanese rates are going to defy that trend significantly. There's a couple reasons for that. The first is that Japanese inflation does tend to be correlated with global inflation. And so if global inflation is eventually, not today and tomorrow, but eventually going to be low enough to permit an easing cycle, including one that the Fed fully participates in, inflation in Japan is going to calm down as well, I would say. And if inflation is down, it's going to be difficult for the Bank of Japan to keep plowing forward. So that's kind of number one. Number two, the other thing about the Bank of Japan that's interesting relative to other central banks is there isn't much of a long-term guidance for where interest rates should be, at the end of the cycle, or a neutral interest rate, as it were. The Fed has the dot plot. Many European central banks have forecasts or fan charts or some guidance as to where policy will or should be, over the medium to long term. And Japan really doesn't have that. Now, I think that they have been considering this, and I think that if it's put forward and it's low enough, that would probably stop the yen carry trade from unwinding in a very, very messy manner. But that's one of the things that I think the market really needs in order to have some certainty about where that interest rate differential is going to settle. And that leads to the final point, which is uncertainty itself. Normally we can think of uncertainty in market terms as volatility, and volatility is a killer in itself of a carry trade. If you have, roughly speaking, 5 percentage points difference between U.S. rates and Japanese rates, if your volatility is, let's say, less than half of that, so 10% or less, well, you could say you got a 50% or better chance of realizing that carry differential. But once vol spikes, because you don't have the certainty, Japanese rates have become unmoored, who knows how high they're going to be, let's have some more volatility. The same differential is not as attractive because the likelihood of realizing it is quite a bit lower, and we've seen that in a pretty brutal fashion in the last couple of weeks. So I think it's pretty important for the Bank of Japan to put forward a more medium-term guidance for where rates are going to be. That's some variant of what other central banks do.